Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 24th of March, 2022. It's a Thursday. It's Thursday morning, and the markets are bouncing back a bit after a sell-off yesterday. I'm going to talk a little bit about the volatility and why things are going up one day, down next day. We probably know why, but we're going to delve into that a bit. The oil rally also continues. We need to look at that because that could weigh in the markets. However, if we see a pullback on oil, it could be very, very good for stocks going forward. How are your sectors doing year to date? We'll talk about that. And are we on the verge of a major Bitcoin breakout? I'm going to show you the chart, and I think that we're almost there. Meme stocks, are they back? AMC, GameStop rallying. There's an ETF that tracks them now. We'll talk about the meme stocks, and then three niche stocks. Three stocks you probably never heard of. I'm going to share with you in three areas that, regardless of what's going on in the world right now, should continue to do better. And again, in niche areas you probably never even thought about. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is Thursday, March 24th, 2022. Hope everybody is having a wonderful week so far. We have the markets doing pretty damn well today. We have the S&P this morning up about 0.4%, but not too far, just 2 days off a 1 month high. We talked about that on Tuesday when I did the show that we were breaking out to a 1 month high in the S&P. And of course, the day after we have some selling. The markets were down yesterday, closed near the lows of the session, as there was concerns, obviously, with things going on in Ukraine and Russia. Oil prices, which we'll talk about in a minute, continue to move higher. So there was a bit of this fear, and you can see the rally that it's had just in the last week or so. So it's had such a big move that it's not abnormal to see a little bit of profit taking, a little bit of a breather. If we can see a follow through today and even tomorrow into the weekend, that shows that the bulls are definitely taking control of the market here in the near term. Again, from day to day, week to week, I'm not as concerned about the action in the market. But what I do like to see is if you have this powerful move, which we had off the low last week into this week, to have some follow through. And the pullback should be not as deep, obviously, as the prior pullbacks. I will say one thing that does concern me. You can kind of draw a line right down here in the chart, which is a series of lower highs. And then you can see a series of lower lows. So really, in the short term here, we are in a short-term downtrend. To break that, we'd have to get up around the 455, 460 level, ideally above this, for a nice breakout for the S&P 500. But you get up there, and suddenly you're 5% or so from an all-time high. So I was watching CNBC yesterday, and it's such a joke. They had on Josh Brown, who, most of these guys don't even manage real money or even own stocks. And telling people what to do. And it's fascinating to me to hear one day bullish, one day bearish. Part of the interview talked about the stocks hitting new lows, breaking lows of earlier this month. Later in the interview, no more than 90 seconds later, talking about how you can see stocks hitting a new high. So it's nice if you could play both sides of the fence, and at the end of the day, whatever it does, you can go back and say, I said that. Well, the problem with that is that's not realistic, and that's not how you manage your money, because you can't go back to TD Ameritrade or Fidelity or Schwab and say, hey, I picked both sides, and so give me the winner. So if the market goes up, I want to be in. If not, can I get my money back because the market went down? So I hate to bash the media all the time, but I'm allowed to because I was in the media for 10 plus years and I see what goes on. And I'm only bashing it because I want you all at home to realize that people on TV don't give a rat's ass about you. They don't care. They want ratings. They want assets under management. They don't care. You know, the shows I used to really like, or not like, I should say, respect to an extent on CNBC, most of the guys there don't do anything anymore. They're just talking heads on TV, so that it doesn't matter what they say. The only way that they continue to get paid for what they do is to have more viewers. To have more viewers, you need to be more bombastic and more outlandish, whether it be good or bad, and make every little thing into a big thing. So it's entertainment, folks. If you turn in for entertainment purposes or just to see the ticker below to see what the market's doing, fine. But keep the damn thing on mute. That's all I'm saying. Again, unless you're looking for entertainment, don't even waste your time. All right, so that's where we are with the market. But I want to show you two charts, which I find a bit fascinating. And I think that you're really going to look at these and maybe get a different perspective of the market right now. And the first one you can see here, it shows the geopolitical risk and monetary policy uncertainty. And look at the spikes that we've seen on the right-hand side here. This goes back to January of 2007. And the index level for the purple line here, which is the 30-day moving average of geopolitical risk index. Look at that risk of geopolitical, geopolitical risk that we have. Obviously, that has to do with Ukraine and Russia. I mean, we know where it's coming from, but so high. That fear is just so high right now. And then you have the U.S. monetary policy, that uncertainty index, which is all about, obviously, the Fed and interest rates for the most part. And you can see here, there was a spike, the high spike really we've seen in that time frame. That was right at the height of the pandemic, early 2020. And then we had it back here in 2019. There was fears of interest rates going up. At that point, it spiked. So we're at the highest level that we've seen since the pandemic. And you take away a couple of really outliers, it's a pretty high level we've seen here. And the reason I'm showing you this is because, again, I'm just showing how the world is right now, how things are so uncertain, how people are so scared. And again, I'm human too. I feel the uncertainty. I lay in bed some nights and I think, man, oh man, this could get so much worse, whatever it is I'm thinking about. But in reality, I've learned over the years that most of this stuff doesn't come to fruition, thank God. But sometimes it does. And I had a bit of an epiphany the other day. I think it might have been last night or the day before. Somebody was talking about a company. I can't remember what it was. It was a big company. I looked at the chart and I'm like, holy smokes, this company's down like 65% or something, lost 2/3 of its value. And I thought to myself, this has to go up 200% just to get back where it was. Could it take 2, 3, 4 years? Who cares? 5 years. If you can make 200% in 5 years, where the hell else in the world are you doing that? It's crazy. With liquidity, to sell whenever you want, not like a house. You can't just sell a house tomorrow with liquidity. And I look at the market and I see some of these stocks. And if you have a time frame, at least 5 years, where if you just invest in a market for the next 5 years, the odds of you making money over history over any 5-year time frame is about 89%. So you got about a 9 in 10 chance. So the odds are with you, and especially if you're investing in solid companies. So when I'm looking at these things, and sometimes I say it, but if I really look and think and take a deep breath and kind of look down on things, you realize that, my goodness, like this is the greatest thing in the world to be able to have money to invest in the stock market. Because yes, things don't go up and down. Somebody asked me about actually a relative of mine about XBI, which is the S&P Biotech ETF. And it's beaten down. It's down about 40% or so from the high. And I look at it and I think to myself, the companies that are in here, and again, I'm not a huge fan of ETFs. I'd rather build my own little basket. But you look at this and it's like, in 5 years from now, this could be to a new high just because of the breakthroughs that a lot of these companies are potentially going to have in the biotech industry. And biotech's not dead. I mean, we're just getting started. It's still in its infancy in a grand scheme of things. To me, it's only a few decades old. So again, you look at stuff like that and it's like, wow, yeah, in the next 2 days, 2 months, 7 months, 8 months, things could be crazy. But over time, as long as the world doesn't end, it only ends once, these things should continue to move higher. So again, just want to show you the uncertainty that people are feeling right now. The next chart I want to pull up, this is investor sentiment. These sources comes from AAII, American Association Individual Investor. And this is the 4-week moving average. So it smooths it out. But as you can see here, this purple is the amount of bulls. So it's down below the level that we've had over the last few years, even below the pandemic low. And then on the upside are the bears. We're just off a multi-year high, or 1-year high, I should say, on the bears up here, or on the bears. Again, typically when you see this, this is a great buying opportunity based on past levels. Over here, it's the equity put to call ratio. And this kind of aqua looking line is the put to call. Puts are negative. If you're buying a put, you're looking for the market to go down. If you're buying a call, you're looking for the market to go up. And this is the 20-day moving average, so it's smoothed out as well. So there's no big spikes in it. But you can see that the last time it did spike, obviously, was here, and that was the pandemic low. And you can see that's when the market pulled back over 30%. We can see here we're at an elevated level, though, for the most part, and we're now getting people to be a little more bearish. And typically when that happens, it's a nice time to buy in the stocks. Again, folks, I just like to show you what's really going on underneath the hood, what's going on behind the scenes, what people here are looking at and talking about. But more importantly, this is the mentality. So this is the mentality of what we're seeing of people as measured by sentiment, because it is psychological what we're looking at. All right, so that's where we stand with the markets. I continue to be bullish. I continue to think buying on pullbacks is a great idea into solid companies. We just put out 2 new reports last night for our subscribers of the McCall report. You can go to stansberryresearch.com. As low as $49 a year. 5 brand new stocks just went out last night, focused on battery and transportation. And if you look at the battery stocks over the last 2 weeks, pick any battery stock. They are rocking and rolling. I'm not going to name names because we obviously have a couple in the portfolio. I own a couple myself. But yeah, I would take a look at those battery names. They are rocking and rolling, folks. And this is a trend that is going nowhere. If we have 3% of sales, give or take, of electric vehicles in the United States now, and eventually that's moving to 100 at some point, or at least 99%. Just think about that. From 3 to 99, that's 33x. Think about the amount of batteries in EVs. This is the upside here is so big, folks. You just can't overlook this. But again, a lot of these small companies, they're not making money yet, have been crushed. And that's what happens in this type of environment. But eventually they come back. And buying down here, and a lot of them are up 40, 50% off the lows already. Still a long ways to go. So again, we just put out 5 brand new stock ideas last night. So speaking of batteries, we'll go the opposite route, and let's take a look at oil. Take a look at USO, which is the ETF that tracks oil. You can see it's down a little today. Oil is at about $114 a barrel right now. We're above 130. We fell down into the mid 90s, back to about 115, 116 yesterday. So you can see that the volatility that we've had here. And again, this is a lot to do with the conflict that's going on in Ukraine. It has to do with potentially more supply coming in from the Middle East, may or may not. What's going to happen here in the U.S.? Will more energy producers start turning the spigot back on, potentially, with oil prices and gas prices this high? But we'll see. And then obviously it's coming to the end of March. We're not too far away from the summer driving season when demand does pick up. So it's going to be interesting to see if we don't have some type of resolution to the conflict in Ukraine by then. We could see a spike in gas prices, and I would not be surprised. So something we want to keep an eye on. But right now it's a bit volatile. It's really all over the place. Somebody asked me the other day, what sectors are doing well? And I thought that's pretty interesting. So I wanted to pull that up. I have a chart here year to date. I just picked a bunch of random sectors, and it looks kind of jumbled, this chart. And it's just trying to prove a point here that there's really an outlier right here. And that is XLE, and that's the energy ETF up top. XLE has obviously outperformed, and we just talked about oil. So obviously we know why it's outperformed. If we go down a little bit here, we can see aerospace defense up 8.4%. That's ITA is a symbol. And why is that up? Well, obviously because the conflict that's going on. That's definitely helped the movement of the stocks. Just below that is gold shares, GLD, up 6%. So those are the only 3 of the major sectors out there that have done really well this year. Utilities down about 0.8%. You had the financial sector, because interest rates go up, it's good for financials, down about 0.8%. And then you start getting down 4% all the way down to down 11% for technology. And the S&P is kind of at the lower end of the range there, down about 6.6% heading into today's. I got these numbers last night. So just wanted to show you that, yeah, it's a tough market right now. And most people's portfolios are down this year. But it doesn't mean that you give up just because the markets pull back. I always talk about corrections happen about on average once every 12 to 13 months, so once a year. And a correction's a pullback of at least 10%, usually 10 to 20%. Bull markets happen every several years. And it's part of just the cycle, you know? I always say I want to live through many, many bear markets, many, many recessions. It means I have a long, healthy life and live through it and get to see a lot of ups and downs. With those ups and downs, people say, "My God, you want to live through that?" Comes opportunity. You know, if you're doing this right, you buy in the dips, you save up your cash. But when the dip comes, you buy into it. It grows. You keep doing this. You could average down over time in your 401k, whatever it might be. But you want to continue to buy these dips. That's how you make money long term in the market. So what about Bitcoin? So I talked about this briefly last week, but I didn't get too much into it. So I have a chart here. This is of Bitcoin right here. And we're around 43,000 right now. I always like to look on my phone because it keeps me up to date of how my portfolio is doing. And it's wild like everything else, as you can imagine. But right now we have Bitcoin trading at around 43,100. So pretty damn good. It's had a nice move, obviously, from the earlier this year when we were down in the low 30s. But I put these blue lines in here for you. And this line here represents a bit of a resistance. It came up to around 45,000 in January, failed in February twice, failed again in early March. But what has happened on these pullbacks, the first pullback was here around 34, actually got down in the low 30s, rallied back. The next pullback was around 36. Next pullback was around 37. Next pullback around 37.5. The most recent pullback around 41. So we connect these lows. And it's not perfect. It's a little sloppy, don't get me wrong. But what this shows us, folks, is that top line, that horizontal line is resistance. That bottom line, that ascending line, creates what we call an ascending triangle in technical analysis. So an ascending triangle can be extremely bullish if that top line, that horizontal line around 45,000 is broken. Because what the pattern tells us is we keep hitting our head in resistance at 45, not enough buyers to get through that. But in every subsequent pullback, people are buying a little bit higher, meaning we're getting in more, we're willing to pay a little bit more, willing to pay a little bit more, willing to pay a little more, until eventually this coiled spring is kind of what it is. It shoots through 45. And if it does that, which I think it will eventually, I'm not trying to time this, I think it will eventually, and probably run right to 52,000. Which would be about a 13 or so % move from there. Right to it, I think we go, which is a level that you can see from back in December. Late December was a high. Through that, all's out there then. From there, you could see it right back to the 68, 69,000 where it hit in November. So it's a very interesting chart here on Bitcoin. And if we break out again, folks, I think we are just getting ready for a massive move when it comes to Bitcoin. The next topic I want to talk about is meme stocks because they have been on the move, to say the least. So let's take a look here at the two big names, AMC Entertainment. And it's down today about 7%, but you can see here it moved from about $14 to about $23 in about a week and a half. It doesn't look like much on a chart, but that's a huge move. That's about a big, big move. I'll show you a chart in a minute of how big it actually was. And then we take a look at the other one, which is GameStop, probably the two big name ones. Again, GameStop, you can see down here is around $78, rallied up to $150. So basically a double, but down 9% today. So we've had a lot of money coming into these, and a lot of people starting to talk about maybe it's time for them to move again. Maybe it's time for Bitcoin to move again. Bitcoin and meme stocks could not be more different, in my opinion. A lot of the same people own both of them, but I would never buy a meme stock, never. So let me talk about AMC first. Let's go back to AMC and we'll talk about that. And I think it's important that we just look at the company. It's about $11 billion company. They had the revenue, they peaked in 2019, obviously right before the pandemic, around 5.47 billion. This year looking for about 4.6 billion, so it's really not that bad, all considered. But they lost 80 cents, are looking to lose 80 cents per share this year. And from everything I could see, looking at the numbers, they are not going to make money anytime soon, if ever again. So they are losing money. They're sitting on just under 1.6 billion in cash. Last year, they lost 1.27 billion. So that should tell you again something. Billions and billions in debt. And what I think was the topper for me was just, I think it was last week. Company came out and said that they're going to invest 28 million, which isn't a lot. We just told you how much cash they have, but they're burning a ton. They're going to invest 28 million to buy 22% of Highcroft. That's a minor, and it's a minor that was borderline about to go out of business. And they think that they're due for a turnaround. It's amazing to me because Highcroft has all this debt and it's in trouble, in my opinion. And at the same time, they have about an $8.5 billion net debt load, which includes their leasing obligations. So to me, how does that make sense? Investing in a minor that is struggling, like greatly struggling. So you're throwing Hail Marys, you're trying to get press and good PR and all that BS, because people think, wow, silver and gold are doing well now. They're smart. Well, if that's not an example for a short-term top in precious metals, I don't know what is. So I would stay far away from AMC. Now let's go to GameStop, which, again, huge move here as of late. About $11 billion company, too, a little bit less than that. Their revenue peaked in 2018, even prior to the pandemic, as more people weren't going to the stores and buying games. Their revenue peaked at 8.54 billion this year, fiscal year, looking for about 6.25 billion. So again, not horrible, but still nowhere near where it was at the peak. But this is what's crazy. They're looking to lose about $5.28 per share this year, and really no path to profitability. They sit on about 1.27 billion in cash, but no path to profitability. And again, what is their business model going forward? Again, I think they're throwing up Hail Marys, hoping something happens. And again, there's so many better companies out there, folks, that I think you should be looking at. So I always like to talk about the ETFs that are potentially tied to this. And Roundhill came out in December with the meme stock ETF, and the symbol's meme, MEME. And it opened in December, and it closed that day around $16, almost $17. It's at $10.74 today, but it was down in the $8 range just about a week and a half ago. And you can see here in the chart, it just looks ugly. But what's fascinating, again, to me about this is you have the stocks doing well, GameStop and AMC, and then you look at I have the wrong chart here, but just take a look here, though. This is a chart I have up here. This is from March 14th. Just look what GameStop has done coming into today, up 80%. AMC up 55, S&P is up 7 in a time frame. And I will tell you, it got erased here somehow, but MEME, the ETF, was up about 23%, so greatly lagging. So you're supposed to be tracking the memes, and this ETF can't even achieve what it's trying to do. And the two biggest meme stocks, again, AMC and GameStop. AMC is number 15 holding, and GameStop's number 22 holding out of 25. Top holdings are Bumble, Square, DocuSign, Neo, and Zoom. And I guess their philosophy here is they look for stocks that have high play in social media, high social media coverage, and then a high short interest ratio, which, a lot of the meme stocks did. And then they rebalance it every 2 weeks. Well, I don't even think this ETF will be around in a year from now for many reasons, but the fact they have 1.6 million under management right now is you're losing so much money. There's no way they can run an ETF with 1.6 million. So again, folks, you look at this and it's just, these are the things that are just hype. These are not real. I mean, I guess they're real, but you don't want to be wrapped up in this stuff. So please stay away from the meme stocks. I mean, I know I'm going to get backlash because somebody's third cousin down the road who lives in, Montana made $48 million owning GameStop or something stupid. Sure, there's always a story, but what about all the people that got fleeced? And I'm sure there's a lot, and I know there's a lot actually. Last topic I want to talk about, and there's 3 stocks here I want to look at. And I was doing just some research, as I do every single day, trying to find new stock ideas for my subscribers. And a couple of these stocks I've had on a watch list already, But I was looking for trends that I believe, regardless of what happens right now in the world, these trends are already underway and they're going to continue. So one is in healthcare. And when it comes to healthcare, there is a shortage of healthcare professionals. And so you're always looking for more. They're paying them more and they're at work a lot. They want to be comfortable. They want to look good too. And enjoy their work life as most people should, or as all people should is work. So a company I've talked about in the past is a newer IPO from last year. The symbol's FIGS, FIGS, and the name of the company is FIGS. And you can see it opened here back in May around $30, ran up to 50, came all the way down to the low teens here. And then it's bounced back to around 20 and change right now. A little unchanged, down about 4 cents today. And what they make kind of really high-end, nice clothes for nurses and healthcare workers to wear. $3.4 billion company. What I like the next couple of years, revenues are expected to expand by about 23% annually. Earnings looking to expand by about 48% annually. Revenue came in 2019 at 110 million. And in just 5 short years, from 2019 to 2024, revenue is expected to go from 110 million to 915 million. That's really, really impressive. This year, looking for earnings per share of 30 cents. Next year, up to 40 and change. Year after that, 53 cents. So again, you're looking for a gain of about 70% in earnings over a 2-year time frame. Again, really nice growth, top line, bottom line, and a company that I think has an ability to continue to grow and has this brand. Ask anybody in the healthcare industry if they know FIGS, and they do. Just starting to get kind of more mainstream as people talk about it. And I think they went public just at a rough time and it got hit after that. But I think this company is one I think you want to add to your watch list. Again, remember, nothing here is buy or sell recommendation, never is, just ideas and educating you along the way. The next one is a stock that I actually owned, and I had to sell it last year because I was moving companies, selling companies, and doing things, so I had to get out of it. And it's a company that stayed on my watch list, and it popped back up this past weekend. The name of the company is Formula One Group, FWONA, and obviously it's Formula One Racing, about a $14.5 billion company. They had the first race of the 2022 season last weekend. And the reason, again, this popped back on my radar was it became the most watched F1 race on cable TV since 1995. This one was broadcast on ESPN since 1995. So you're looking at, 27 years. It's pretty impressive. A lot of people say that the popularity in F1, which is extremely a popular international sport, not as much here in the U.S., but it's starting to pick up a little bit. But internationally, it's enormous. This was the Grand Prix Bahrain, which was, again, kicked off the season. And I've actually been to Bahrain, so I was trying to watch videos to see if I knew where the cars were driving through. But there was a Netflix series that debuted in 2019 called Drive to Survive about F1, and that really picked up popularity. But when I go to Nicaragua, I have some friends down there from Canada and Europe, and they get up crazy early in the morning on whatever the days it is. It's usually a weekend to watch their F1, and it's a big international sport. I personally can't get into it, but it doesn't mean I can't invest in it. So revenues, they peaked in 2019, obviously, because things got kind of wacky with the pandemic. They peaked about 2.02 billion. Looking up to 2024, 2.87 billion. So not a huge growth. This year, earnings per share of 19 cents and up to the mid 60 cents a share by 2024. So that's a nice pickup. That's a triple in earnings in a matter of 2 years, which is really impressive bottom line. So I think they're going to continue to figure out how to make this company more profitable, increase margins, and I only think popularity is going to continue to grow. So again, you look at the chart. We're up at basically a top here. If it breaks through there, it could run. I would never look to chase something up $7 in the last 2 weeks here, up 15% or so. But again, this trend shouldn't end any time. And as things start to reopen more and more, it should only get better. The last one has to do with batteries and EVs, and it's a smaller company. And there's one part of the lithium-ion battery, and even not solid states, but a lot of the batteries looking to use more nickel. There's one mineral that's really important to batteries, and a lot of people think lithium and cobalt off the bat. It's graphite. And, graphite demand for just the EV sector alone is expected to increase by 35% this year. And outside of lithium, Graphite's expected to see the biggest increase in demand from current levels of any other metal or material that goes into batteries. And there's the cathode and the anode, the two sides of the battery. The graphite makes up the anode side. So the company I'm talking about is an Australian company, and I'm going to pull up the ADR, the OTC here. It trades over the counter, but its main shares trade in Australia, but you can buy it in the US over the counter here. It's Syrah Resources, symbols SYAAF. Down about 3% today, but you can see it's had a big move in the last week and a half. Kind of a choppy chart, but it's had some big spikes up and down. It's about an $830 million company. And they have the graphite mine by the name of Balama, Balama, graphite mine in Mozambique. And what I like about the company too is there's a bunch of graphite plays. I've been doing a lot of research on graphite. They're looking to expand to be more of like a vertical operator, meaning like kind of being involved in all aspects of getting the graphite out and then getting into batteries. They're looking to be a producer of natural graphite, what they call active anode material, AAMs. And they have a facility in Louisiana they're looking to do this at. So that's kind of cool. And revenues in 2021, last year, 28.2 million. By 2023, so next year, just 2 years growth to 191 million. They should be profitable as well in 2023, path to profitability. And in the next couple of years, revenue is expected to grow annually 85%, earnings 98%. So you're seeing huge growth in this. And again, batteries aren't going anywhere. There's going to be a new technology come through. Maybe it's solid state. I think we're going to go solid state, but you're still going to need graphite for the foreseeable future through the roaring 2020s. Companies like this, more established companies based out of Australia, not in some region that's really volatile. And I got to tell you, folks, I think that this is one you want to keep an eye on. So there's three ideas, three completely different ideas. I mean, one that makes apparel for healthcare workers, Formula One racing, and graphite mine in Mozambique. So that should tell you the different ways I look for ideas. I don't care where they come from. If I think they're in a mega trend, and I think that trend's going to continue, and I think the company can be a leader in that trend, and I think ultimately it will make you money, heck, I'm going to talk to you about it, because that's what our goal here is. Remember, we have 3 goals in this show in making money. One is to educate you. That has to be the most important. Number 2 is to have fun along the way, because if you don't have fun, you're not going to come back. And number 3, make money. And of course, if you don't make money, you're not coming back. You put those 3 together, we have one hell of a life, folks. So again, thank you so much. And we'll take a look real quick at the S&P. We're up about 0.4%. Not too much action today. We'll see how we close. But again, a little consolidation right here in the markets is actually a really good sign after the rally. I'll be back on Tuesday live from the office, the studio back in Baltimore. But until then, have a safe weekend. And remember, markets are going to go up and down. Keep smiling, keep your head up, stay safe, be good. Go hug somebody, shake their hand, tell them hello, pass the love around, throughout the world. Let's make this world a little bit better day by day. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.